to this overview on Unit 12 covering leases. Lease accounting has been a topical issue for a number of years, and in January 2016 the IASB issued IFRS 16, which will become effective for financial periods beginning from 1 January 2019. This unit looks at the application of IFRS 16. To apply IFRS 16, we need to work out whether we're dealing with a lease. So firstly, we need to look at the definition. So a lease is a contract or part of a contract that conveys the right to use an asset, the underlying asset, for a period of time in exchange for consideration. We then apply the appropriate accounting for the lessee or the lessor. The definitions within IFRS 16 are so important when you apply lease accounting, so make sure you read those. So assessing whether a contract is or contains a lease involves considering whether we have an identified asset, such as this machine, and whether the lessee is able to control the use of the identified asset, and this involves the right to substantially all economic benefits from its use and the right to direct the asset's use. Firstly, looking at lessee accounting. You'll find this diagram in the CSG. We analyse the lease contract and we determine whether a recognition exemption applies. So this might apply to short-term asset leases or low-value asset leases. And in that situation, they're accounted for like a rental agreement, so the lease payments are expensed. But the majority of your work in this unit is going to be about recognising a lease on the statement of financial position. So most leases come onto the balance sheet for the lessee under IFRS 16. To do this, what we're looking at is recognising a right of use asset, so the right to use the underlying asset. We don't recognise the asset itself, it's a right of use. And correspondingly, we recognise a lease liability on the balance sheet. And there are special rules outlined in the CSG about how to calculate these values. Subsequently, what we do with the right of use asset, as you might expect, is we're going to have to remeasure, and usually that will involve depreciation. So this links back to what you did in Unit 7. Also, with the lease liability, we need to adjust that subsequent to the initial recognition. We're going to add interest on and subtract the lease payments. And the interest is calculated using the interest rate implicit in the lease, or if that's not known, the lessee's incremental borrowing rate. So this is very similar to the amortised cost calculations that you did in Unit 9 on financial instruments. Moving on to lessor accounting, you'll find that how you account for a lease from a lessor's perspective depends on how the lease is classified. It's effectively the same accounting treatment that applied to a lessor under the old accounting standard IAS 17, and you may remember that accounting treatment from your university studies. A lessee classifies a lease at the beginning of the lease as either a finance lease or an operating lease. A finance lease transfers substantially all the risks and rewards incidental to ownership of an asset, and that gets transferred to the lessee. The legal title of the asset may or may not be transferred to the lessee by the end of the lease term. An operating lease is a lease other than a finance lease, where the lessor retains substantially all the risks and rewards incidental to owning that particular asset. So an operating lease could be, for example, where a lessor owns an office building and effectively rents it out to a lessee. So in this situation, the significant risks and rewards of owning the asset are not passed to the lessee. So what IFRS 16 says is that the lease receipts that the lessor is earning are recognised on a straight line basis over the lease term. However, there's an exception where another systematic basis is more appropriate, but generally it's just on a time frame basis over the lease term. And because the lessor is effectively retaining those risks and rewards of ownership, it retains the asset on its balance sheet and then must depreciate the asset under IAS 16. For a lessor, if there's a finance lease, remember that's where the significant risks and rewards of owning the asset are passed to the lessee. So this could be, for example, with the lease of a machine. What we're dealing with in Unit 12 is where the lessor is, for example, a finance company. So it's just really in the business of effectively lending money to a lessee. So we're dealing with leases other than manufacturer or dealer leases, which are beyond the scope of the fin module. So what the lessor does is, because effectively it's like a loan, they recognise a lease receivable at the beginning of the lease. Over the lease term, they're going to recognise finance revenue. So that's at the interest rate that is implicit in the lease agreement. And again, this is looking like what we covered in Unit 9 with that amortised cost basis. And the lease receipts are allocated between the finance revenue and the reduction of that lease receivable asset. Some other issues to look out for in Unit 12 are about separating lease and non-lease components and sale and leaseback transactions. So enjoy Unit 12, lots of little examples to work through in the CSG and other worked examples and an activity.